Are we facing an affordability crisis going forward in 2021? I can tell you that some people think we are. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 4th of January, the first video of the new year 2021. I hope everybody had a great holiday week, time off, New Year's, whatever you were doing. Time to get back to the real world now, and we're going to talk about what's planned or what our issues, our main issue really is, facing, I guess you could say, 2021 with respect to housing. So we'll go from there. All right. So first of all, if you are not already a subscriber, if you could do me a really great favor and subscribe to my channel, I would most appreciate that. Thank you very much. All right. So basically, over the the holidays, I do a lot of research and looking at stuff on the internet and delving and reading and whatever. And right now, I'm I guess some of the main topics of information that we're sort of going over the holidays was basically affordability. So in other words, where is this market going to head? Is it going to top out? Is it going to crash? I mean, those are the big questions we all have with respect to housing. So do we have an affordability crisis? That's kind of like the big thing right now. So let alone, we're in, not only are we in a housing bubble, which will prove that again shortly, now it comes down to the fact where, can people simply afford homes? I mean, everyone's getting priced out. Everyone, I think, is sort of at their limit right now. And how is this going to affect the market and affect people's, I guess, real estate needs on a going forward basis? So basically, we've got a lot of information here we're going to go through. Chances are this is going to be a longer video, so be prepared for that. So basically, this came out the other day. U.S. housing enters 2021 in a massive bubble. So obviously, we've gone through the last video, the Case-Shiller information. So we know Case-Shiller is up, of course, double digits. And essentially what they're saying here is that, I guess on December 16th, Fed Chairman Jerome Powell was specifically asked if he's seen any signs of valuation pressures in the U.S. housing market, which according to the latest Case-Shiller data was surging at its fastest pace in the past 6 years. Predictably, Powell was not concerned about the recent surge in home prices, and he said as much during the question and answer component. So really, it boils down to, I would say, from a financial stability standpoint, housing prices are not of a level of concern right now. That just reflects a lot of demand, and builders are going to bring forth supply. Housing prices themselves are not in a financial stability concern at the moment. We will watch that carefully, but in the near term, I wouldn't think that's an issue that we'd be concerned about. Well, I'm concerned about this statement because I don't think it's a very good statement from him. And also that comment about builders are going to bring forth supply. That is kind of like the de facto deflection answer saying, well, we have a supply issue, so the builders are going to deliver for us. Well, we know that the builders can't deliver for us. And it's not the fact that they don't want to. The fact of the matter is, they have their own issues as well, too. There's only so many homes that they can build in a calendar year. And also, with respect to price point segments, that's where we have issues. Builders are not able to build in the price point where most people need them to be for various reasons. So essentially, this is kind of the situation we're in now. Home buyers face affordability crisis worst in 12 years. So again, between record low mortgage rates, thanks to the Federal Reserve, Congress fiscal stimulus checks, and record debt-fueled demand, extremely low supply, the housing market's entering 2021 in what they call a bubblicious territory, surpassing levels not seen since the 2006-2007 housing bubble. Of course, surging home prices mean that millennials can't afford to buy, as this has pushed affordability to a 12-year low. So again, citing a report from Adam Data Solutions, they said home buyers in the fourth quarter had to spend at least 30% of their wages to afford the average American home. That's the largest share of any quarter since 2006. There's a little chart there, so we can see that the affordability and really that line is, percent of wages required, income needed to afford a home, and you can see that, it's gone up, and it's not quite to the 2006 level, but it's approaching that, and it's kind of working its way up on a higher trajectory. So that's the situation we are in right now. And when you look at that, I mean, what else can you say about it? We know what's going on. We've got low interest rates. We've got low inventory. It's stimulating, competition and price gouging. and more people have to spend more of their income on their housing needs, which is really a strain on their personal economy. So ultimately, and we're going to go through a number of slides here, so just be patient with me, and I'll put the link to where you can find this on the internet in the information section of the video. But ultimately, in the end, the housing market has the following stats and charts. This is from Goldman Sachs put out a report, and you could basically see that we've I guess a 30-year mortgage has fallen between by 100 basis points between Q4 2019 and Q4 2020. 29% of single-family housing starts increased by 29%. 29% of single-family housing starts where was the increase from October to October from 2019 to 2020. Case-Shiller U.S. house price has grown 7% from 2019 to 2020 in Q3. 80% of all outstanding conventional 30-year mortgage borrowers have the 50 basis point or larger refinance incentive as of now. And 2.8 trillion agency mortgage-backed security issuance year to date has totaled 2.8 trillion, up from 1.4 trillion in 2019. And obviously, Federal Reserve mortgage-backed security holdings increased by 800 billion over the past year. So basically, they're saying if based on this activity tracking, if this isn't a bubble, then we don't know what really is. Okay, so let's go into it. So Goldman Sachs has all their graphs here. So housing sales and starts have surged. So yeah, we're going to see a lot of V-shape, charts here, and that's cool. But remember, when you go to the very right of this chart, like we can see a little dip there. So because the chart's compressed, we see everything pops up, and it took a little dip towards the end of the year there. So, but the whole point, when you look at this from a 2018, 20-year perspective, you say, okay, look, it's we have the V, and essentially, it's everything's rising at an exponential, I guess you could say, exponential point. So housing sales and starts have surged significantly. Next slide we'll take a look at here is going to be housing starts. Again, single-family housing starts are up year over year. National Home Builders Housing Market Index and housing starts, are up. Housing starts are up again. Fannie Mae Home Purchase Sentiment Index, did you can see that's the bottom left slide, did plummet, and it was back up, took a little dip. Pending existing home sales took a big dip with the pandemic. It went really high. They took a little bit of a fall the past month or two. But again, when you take a look at where it's gone, it's done a big recovery from that perspective. All right, inventory of homes available for sale basically has dropped dramatically over the past couple of years. Share of pending home sales looks like off market within 2 weeks or less. So what that really means is that people are buying quicker and they're going under contract quicker. Single family homes available for sale annually has been dropping. Month supply of single family homes has been dropping dramatically as well too. It's record low, so record low inventory. That's what we have going on here. More charts from these guys. Let's get to the next slide here. And primary, secondary mortgage rates are dropping, as we can see. Jumbo versus conforming mortgage rates, they're dropping as well too. Distribution of outstanding 30-year conventional mortgage borrower interest rates, you can see they've been dropping. Percentage of outstanding 30-year conventional mortgage, mortgage in the money for refinancing. So obviously, we got a lot of people refining right now into their 30-year fixed rate mortgages, which extends their payment terms. We take a look at Federal Reserve holdings plus commitments to buy agency mortgage-backed securities. So the Fed has committed to buy mortgage-backed securities, and they've done a lot over the past little while. And the bottom chart there shows Federal Reserve gross monthly MBS purchase volumes. So it basically is they've purchased over 100 billion of MBS in November alone. You can see where they're stacking up in 2020. So they certainly have ramped up their mortgage-backed security purchases. So they're underwriting these loans, and taxpayers will be on the hook for that, obviously. Some of the stuff here is senior loan officer opinions on mortgage lending. Credit availability is tightening up a little bit, but it's still pretty reasonable. Basically FICO originations, I guess you could say scores are slowly moving up for mortgages. Share of homes with DTI above 43%. I'm going to actually make this slide a little bigger. When you take a look at it, this is where I always talk about my concern for some mortgage exposure here. So if I get this a little, hang on, here we go. Okay, so basically that's the bottom right slide blown up here. So shares of loans with debt to income ratio above 43% for purchase mortgages. So now we see the share of mortgages with high DTI has moved down. So it's moved down, a little bit. You've got the GSEs, which are the dark blue, and you got FHA, VA, which is the lighter line there. So you can see that in 2019, significant amount of loans on both GSEs, government-sponsored entities or enterprise, which are Fannie Mae and Freddie Mac, and then FHA, kind of peaked with their debt-to-income ratios being above 43%, and you could see that for the FHA side that almost 50, like over 50%, looks like almost 55% of loans issued. You see how it peaked there. They had DTIs were greater than that. So the risk factor on the borrower profile was certainly up. Yeah, it may have dropped a little bit, but look at FHA, still above 45% of the loans are higher DTIs. Now, funny enough, if you follow some of the videos that I've been talking about here, every month I'm doing a FHA delinquent loan tracker, and FHA, or where the people who actually produce the information, comes from FHA, but there's another group, American Enterprise Institute, that summarizes it very nicely. What they're pointing out in some of their, their columns on their charts are the fact that there is a significant amount of 2019 originated FHA loans that are in delinquent status. What that basically means, and when you go, and this is why this really makes sense, if you go look at this chart here and see that, sort of over the 2019, as we 2018 to 19, kind of was, peaking of debt to income ratios being above 43%. And when you then look at, funny enough, 2019 has a higher share of delinquent loans. So really, you got your loan in 2019 and then you were already delinquent in 2020, whether that's because of economic issues or for forbearance. It could be a bit of both, but the point is that loan, we'll call it loan time segment of 2018 kind of 19, really has a ton of that's where a lot of delinquencies are, which kind of goes in hand when you start looking at the data, saying, well, that's where we can see the most debt to income ratio being above 43% was happening. So that seems to sort of, everything kind of lines up with respect to what's going on. So it's just interesting to note that. Obviously, we're seeing wealth transfer. We're seeing people leaving specific areas of the country, moving to other locations for various reasons. What we're also seeing is the fact that younger people, the share of young adults living with parents has remained elevated. So basically, as things became, increasingly unaffordable, which is sort of like 2018 to the end of 2018-19, where we are today, that more and more people are living, more and more adults are living at home with their parents for various reasons. All right, and that just goes to show that they're maybe potential first-time home buyers. They can't afford or don't want to get into the game when prices are so high, which would make sense. Household formation. Well, the issue is that we have an increase in household formation. So what that basically means is that more and more households are forming. So guess what? That means there'll be more need for accommodation, whether that's to purchase property or rental accommodation. Either way, it boils down to more households need to live someplace. So, they're forming and they're growing. And as we just saw in the previous slide, a lot of people are still, back home or haven't left their parents' place. Rental vacancy rates hit near historic lows. Obviously, in 2020, we saw a little bit of an uptick on vacancy rates lately. That may have to do with some of the mega cities, and I mean by that the New Yorks of the world, the Miamis, the San Franciscos, where there certainly is marked increases in rental accommodation that's available. But again, that could be, based on the fact that more people are, number one, just leaving the area, working. They're able to go to cheaper locations to rent or to purchase and work from home based on where they, their jobs, etc. So, and we know that people are leaving San Francisco area. Other people are leaving the New York area, and there's a lot of inventory on the rental side, and the rental accommodation has been dropping prices 20-30% from where it used to be. So homeownership rate did spike up. We had the biggest homeownership rate, I guess, historically, just before, you can see 2004, just before the last housing crisis. And then obviously when the last housing crisis came, it's been pretty much a downward trend till just over 63%. You can see hit the bottom in 2016. It kind of jumped a bit up to 68% and sort of tackled down a little bit as well too. So in the past couple of months, but again, homeownership rate wasn't where it used to be. Going further into some of this information, let me get the next slide here. And what we're going to see here is that obviously ratio of financial obligation payments to disposable income is going down. So basically, as interest rates are lower, more people are, either paying stuff off, or, what I mean? Like, this is financial obligations, including debt payments, lease payments, property taxes, and rents relative to income are low by historical standards. So, this slide's saying, I guess we're making more money and our obligations are less. But I know a lot of people do have a lot of stuff on credit. A lot of tenants are paying rent on credit card. Debt service ratio to debt income level is dropping, and it's dropped a lot recently. All right, whether that's because of checks or whatever. Share of U.S. mortgage borrowers and forbearance plan. Share of U.S. mortgage borrowers and forbearance plan has declined in recent weeks. Now, this is one of those things where it literally is a weekly statistic. And the last thing I checked before I record this video is the fact that we're still hovering around 2.8 million people in forbearance. And that's still a significant amount. And we'll see how that plays out. The majority, about 80% of the people who are currently in forbearance have gone through at least one forbearance period and had to extend and re-up for a second forbearance period. And remember, forbearance is only available for a total of 12 months. Once you hit the 12-month sort of limit, it's like, okay, well, now you have to decide, are you able to bring your mortgage current or start paying on your mortgage, and the lender will work something out with you. If not, then you're going to fall into the foreclosure bucket, and that process will start. And guess what? We're in January, and the full year is coming up, end of March, right? So we're going to see what happens the next little while and see how that plays out. So that's what's going to happen down the road here. This is an interesting slide as well, too. And we took, median price of new and existing family home sales. Basically, you can see that new homes, are rising. Have always been, and existing homes are rising as well too. But the gap between new and existing home prices is narrowing. So now, listen, if you have a choice to buy, a new home versus an existing home, chances are the new home may be a better bang for buck. Why is that? You get a brand new home. You're going to have builder warranties, you got new materials, you got new construction. So your deferred maintenance is going to be significantly less than buying an existing home. But with respect to competition and lack of housing available, you can see that there's been quite a surge 2019 and 20 in the existing home price growth. So therefore, that gap, the differential is starting to change now. I mean, well, it's getting smaller, as they're saying here, which is obvious. So it's kind of like, well, why not just buy a new home? Love to, but same thing. Builders cannot build them fast enough, and that's the nature of the ball game right now. So it's almost like we're getting to this point where it's regardless whether there's new home, existing home, there's just nothing out there, and prices are converging. So that, to me, that's not a good thing. All right, that shows that affordability is not good on existing homes. Percentage homes with mortgages with negative equity has been dropping. Obviously, fewer than 4% of mortgage properties have negative equity, down from 25% in 2011. 2011 is right in the middle of the last housing crisis and crash. So of course, negative equity was huge, and you can see that it's slowly worked its way down over the years. There still are homes that are underwater. That's what negative equity is. You actually owe more on your mortgage than your house is worth in the open market based on appraised value calculations. So, and again, when we dig into this, a lot of the narrative on the housing issue with the forbearances and future foreclosures that are coming, this common narrative is that, it won't be a problem because look at all the equity we have in these homes, so people will just sell and they'll cash out and they'll walk away with money in their pocket. Well, that is to be determined, and that may work in specific locations of the country, but not all places. So we'll see how this plays out. It's going to be different for sure. All right, annualized home price appreciation, as you can see, really it's gone up exponentially. All right, and I mean exponentially. Look at that. After in 2020, we've just witnessed that with respect to the pandemic, bringing it down, and then it's skyrocketing to double digits over the past couple months. So that's what we got to show for it. So this really is, it's a troubling sign if you're looking to purchase a home, whether it's a primary residence, investment, whatever you want to do. It's like things are sort of getting out of control here. So, an affordability crisis, well, again, this is data. This is not me making this up. This is, Goldman Sachs putting this stuff up, so it's kind of obvious. You got Adam Data Solutions, who has, the information at their fingertips, and they're saying, we'll talk about it in a second here. They're saying, we got some stuff going on here. Housing activity tracker, so we can see that housing sales and starts have surged. Again, that's on the new home building side, which we know home builder sentiment's up, but funny, home buyer sentiment is actually down. Now we're going to go into Adam Data Solutions here. So home ownership slips into unaffordable territory across majority of U.S. in fourth quarter of 2020. So this is, again, this is Adam Data Solutions. They've got the information. If they're out there talking about this, and there has to be some, I guess, concern on a going forward basis here. So really boils down to that, essentially, Data as a Service released its fourth quarter 2020 U.S. home affordability report, showing that median home prices of single-family homes and condos in the fourth quarter of 2020 were less affordable than historical averages in 55% of counties with enough data to analyze. That's up from 43% from a year ago and 33% from 3 years ago. So basically, we're seeing a significant, 10%, more than that. So it's up 12%. So unaffordability is up 12% from the previous quarter. So that basically means that, as they say here, rising wages and falling mortgage rates still help keep median home prices close to affordability for average wage earners across the country, but we're losing ground every time here. And I guess that's the main concern, which I fully understand. So again, I'll have the link to this. I'm not going to read the whole thing, but basically it boils down to, where the red arrow is saying owning a home in the United States slipped into unaffordable zone for the average workers across the nation in the fourth quarter as numbers continue a year-long slide in the wrong direction. So the latest housing market data shows an average worker unable to meet the 28% affordability guideline used by lenders. And that happens as home prices have continued rising throughout 2020, and the housing market has remained remarkably resilient in the face of the brutal economic fallout from the coronavirus pandemic. The future remains wholly uncertain, and affordability could swing back into, I got to move something here to read that, swing back into positive territory. But for now, things are going in the wrong direction for home buyers. So they're going the wrong way. It's becoming more unaffordable, less affordable, more unaffordable, however you want to say it, and that should be a concern to us. Home prices up at least 10% in more than 3/4 of the country. So it's not like we're seeing, a Miami, a San Fran, an LA, a Phoenix, in New York going up. We're talking 3/4, 75% of the country is seeing home prices up at least 10%. That's pretty significant. So again, that's big time. We're talking, it says median home prices in the fourth quarter of 2020 were up by at least 10% from the fourth quarter of 2019 in 79% of the counties included in the report. That is huge. Among the 41 countries, I'm not going to go into that because you can read this. But the point is, for the time's sake here, it's going up, all right, and in the majority of our locations. So should you be concerned? Well, I'm concerned a little bit about that. Everyone's getting priced out, and everyone I think is having that buyer fatigue back again. Price appreciation up more than wage growth and more than 90% of the marketplace. So this is where it's telling. So it's unaffordable. We have a data company telling us this, and they're basically showing us that price appreciation up more than 90%, up more than wage growth and over 90% of marketplaces. So we just can't keep up with what's going on in the housing market, which means who's going to buy the houses? Either the more affluent, the more wealthy, or the investor market's going to step in and start doing more of this as well too. So a lot of future home owners may not ever be future homeowners, at least for quite some time, if things continue to go up this way. So that's the situation. Average wages needed to afford medium price homes exceed 75% in a quarter of the markets. Interesting. So of course, different locations across the country, will ebb and flow with, affordability. But you can see that, in some locations, like in the San Fran, New York, and Manhattan area, Marin County, Santa Clara County, you got to be over $250,000 of income to afford an average place there. Pretty substantial. All right. So now you wonder why people are moving to those locations. And again, majority of housing markets are less affordable than historic averages. So we just see that every quarter that goes on, things are getting more and more out of reach. And it's I guess it's great if you're selling. The problem though, if you're selling, you cash out. Where are you going to go? So unless you got another plan, are you just porting equity? Are you cashing out and gaining your equity to just spend your gain on somebody else's property, right? It's kind of like this vicious circle here. So very difficult. And again, number of markets more affordable than historic average decline. So of course, if we see the number of markets that aren't affordable increase, then obviously the affordable ones are declining. So again, it just depends on where you live in the part of the country. You can figure that out and look at the report yourself. So we have an affordability crisis. I'm not saying we have an affordability crisis. Other people are saying we have an affordability crisis. If you go back, in the past couple months, we have, National Association of Realtors, chief economist dude, is saying, yeah, things are becoming unaffordable. We've got, a number of data companies now that are going, things are unaffordable. We have, economic and housing analysts that are saying things are unaffordable, all right? And so we are in an affordability crisis. That's how we're entering 2021. And we got to go back to basic bubble theory. So why is this happening here? Well, clearly we know that low interest rates are inciting people to go out to buy. And, low interest rates, when you do your calculation, because people really look at payments, and they know that if they're, with low interest rates, their payments, can handle maybe more expensive properties. So that's why they're moving up or willing to purchase, pay a premium or purchase a more expensive property. But here's the problem. We have, if you follow basic bubble theory, and, I do read about this, and, what I'm looking at here is that, basic bubble theory, we got bubbles are like a drug, all right? And they make most people feel better or feel high, which is true because we don't want to acknowledge the downside of it. We just want to acknowledge the good side of it, right? The upside. We don't want this to end, so we go into denial as the bubble evolves, especially in the late stages. Governments and major financial institutions go even more overboard. And this is something we'll talk about in a future video, but when certain organizations or groups start to show interest in real estate and want to get a piece of the action, that's when I know that things are overpriced and we've kind of gone into that uber strata of where things are at, because a couple states now are looking at ways of how they can participate in the housing market and start to do more control and benefit the state, the government, whatever, among other things, going forward. So we'll talk about that in another video when I get some more information on that. But the point is that, it's almost like when things are going up, everybody wants to jump in because they think, hey, if I buy today, I can sell tomorrow and make some money, or at least I break even. And that's the comfort feeling with respect to bubble theory. And the fact of the matter is that no one ever contemplates that it could go the other way and you could lose. So that's, never, bubble theory doesn't account for that. It's always up, up, up. And when it crashes or changes, then people are crying the blues. So again, the housing market is manipulated and managed. Clearly we know this, low interest rates, low inventory. We're not seeing, stuff coming on the market that are distressed because that's been choked off as well too. But the key part, though, is that we know this. So it's not like we're going into this blind and we have no idea what's going on in the marketplace. We actually know this. We have a lot of data, and that's why we can look at this. So we have to figure it out and figure out how to work through it. There's always going to be a way, and there are ways if you want to put your time and effort to doing that. So also, I always say, do we have unrealistic expectations? So when you guys email me and say, here's what I'm looking for. I'm looking for, wonderful things in my housing. Oh, but I don't want to pay top dollar. I want to pay 50% discount. Well, that's not going to happen, all right? And, we're waiting to see when will prices drop. Well, it's not when. It's more like if, the way things are going here. Now, should there be some corrections? Probably there will be. It's just the problem now is we're trying to figure out when it's going to happen, and we're trying to guesstimate how much it's going to happen. And, of course, every time it goes higher and higher, it's kind of like the bar is raised. As of the last Case-Shiller, we're seeing, which is October's data, we're 25% greater than the last housing bubble, than 2006. So our bubble has increased 25% from 2006 peak. So that's problematic, and obviously, no one wants to buy at the uber peak for sure. So as I always say, there are properties available right now. You just have to know where to look. Got to look in the distressed housing market side. There's stuff there, and as I always say, the key to this though is that a lot of these homes aren't available. They're not on market, and they're not. As I said, they're not readily available. We got to do a little more work to get our hands on them. But when you do, there's benefits on larger price reductions, and you're feeling good about your purchase essentially. So I'm also seeing some new trends going on. sort of in markets that are associated with some of the, when you look at some of the distressed property, I see that there's certain ways now to make some good cash in the real estate market. New things that are working, or I see some trends that are becoming more prevalent, which seems to indicate that people are going to start jumping on this relatively soon. So if you want more information, I'll tell you about it. You got to connect with me. That's my email. Send me an email. We'll communicate and we'll have a conversation. All right, guys. I know I've talked to a lot of people over the holidays, so appreciate everyone reaching out. Let's get going on some of this stuff. If I haven't got to you, just ping me again. We'll set something up for this week. That's how to get a hold of me, with my email there. So first of all, want to wish everybody a happy and prosperous and healthy 2021. Let's hope it's better than we had in 2020. Let's hope we can achieve our real estate goals and dreams and desires. I think, again, the next couple of months will be critical as we see how things play out with how the market's being controlled. Anyway, thanks for the likes. Thanks for the views. Thanks for the comments. Please share the video with your family and friends. And if you're not a subscriber, do me a great favor and subscribe to the channel. Thanks very much, and we'll talk to you guys later on.